All right, market reaction kind of blunted after a little bit of a disappointment on ADP. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, investors are weighing mixed readings on the labor market ahead of tomorrow's highly anticipated jobs report.
As Nvidia's wipeout fuels concerns, the AI trade gets another test. Broadcom is reporting after the bell today.
Plus, from Verizon's broadband push to U.S. Steel drama, we've got a roundup of today's deals action. So all that and more coming up. Let's take a look at where markets stand 30 minutes until the bells ring. Pretty interesting trade here, even though we're not talking about big movements. The S&P 500 down about 0.1% after that weak ADP print, initially dropping to session lows in the pre-market, now coming up a little bit. The Nasdaq 100, though, your big tech under more pressure here, down about 0.4%. A little bit of movement in the bond market, a little bit of a rally, Matt Miller. You take a look at the 10-year yield, currently lower by about 2 basis points.
Yeah, Chanel's watching that to get down to 370 and break. Take a look at this chart. In the blue, you'll see economic surprises, and they have been softer. ADP was soft today. I guess you could say that initial jobless claims was a little bit stronger, but really bang in line. Nonetheless, we continue to see an upward trend in stocks with those soft economics as investors hope for rate cuts from the Fed.
I literally screamed at my desk after that ADP's report. But let's watch some pre-market movers before we talk about the macro here, because single name news for sure. Verizon agreed to buy rival telecom company Frontier for about $9.6 billion in cash, which is a 37% premium to Frontier's closing price on Tuesday. But you still have Verizon on the heels of that deal, now down about 0.2% pre-market. You also have C3 AI plunging after its earnings disappointed Wall Street. And you have C3 AI down almost 20%. Broadcom down 1.5% ahead of its earnings after the bell. We are going to talk more about that AI trade in a moment.
All right, let's take a look at the economic data that we are all so keenly watching. We had the jobs report from ADP, and in normal times we don't really give it a lot of time. However, this morning there was a little bit of a disappointment, and initially markets dropped.
Initially,
Futures.
And now we're kind of back to where we started. It's interesting if you take a look at the movement around Fed cut pricing. We're about 50-50 as it comes to a 25 or a 50 basis point cut coming in the next couple of weeks. We're still there. So this didn't really move the needle, but it did raise the stakes for what we're going to hear tomorrow.
After that ADP data, the reason I screamed is we watched the 2-year barrel right down to just near 370. It popped right back up just a little bit. But Matt makes a point. Since we started this show, you have the 2-year down a full percentage point since middle of summer, Katie.
All right, let's get a little bit more into the weeds here. Michael McKee, Bloomberg Chief International Economics and Policy Correspondent, joins us now. And, we're processing every piece of data that comes across EcoGo, obviously counting down to the big daddy tomorrow, the non-farm payrolls number. What was your take on the labor market with what we saw today?
Well, we're seeing what I talked about on Tuesday, that everything that we get feeds into the narrative that people will try to explain tomorrow at 8:35 when the numbers are out. It's all about that. And the ADP report, as you mentioned, doesn't always give us a clean read. The jobless claims numbers should tell us something about whether we're seeing layoffs, and we did not. If you take a look at what happened with initial jobless claims, we get 227,000. It was 232 the week before. This is the lowest number in the summer. And the white line there is the non-seasonally adjusted number, and you can see how it has fallen tremendously, and that suggests no layoffs. Now, those red boxes are around July every year. This is what happens. We get this dispersion between the two things. We get a jump in the jobless claims numbers for the seasonally adjusted, and non-seasonally adjusted go down because of layoffs. So we don't get a reading on this that really tells us a lot about where the economy is going, other than it's not in crisis. Then you take a look at the ADP numbers, and I did not scream like Sonali, but they did get my attention. My eyelids rose, I guess. You look at the ECAN function on the Bloomberg, and you can see here what happened and what the Fed may be concerned about. Is the orange boxes are service industry jobs, and you can see the trend just going down, down, down. This is the weakest service industry numbers in about a year. So if service industries are not hiring anymore, then that could be a problem because they are the biggest drivers of hiring. And that's what we saw. Now, ADP has been forecasting manufacturing job losses for some time that haven't occurred. And we did see that again today, them saying 8,000 jobs lost. But it's the professional and business services that will catch people's attention because you do start laying off temporary employees if you think you're going into a recession, and that was down by 16,000 in their number. Information services down by 4,000. So some categories that could be problematic tomorrow to keep an eye on out of ADP, whether or not they prove accurate in the actual level of jobs created.
All right, Mike McKee, we will see you 24 hours from right now as we parse through what Matt Miller says is the Big Daddy jobs report. Let's bring in Lisa Shalett now. She is CIO over at Morgan Stanley Wealth Management. And Lisa, you take a look at the market reaction to this ADP print we got. Of course, initial jobless claims coming through as well. At this point, I don't know what would be good news for the market at 8:30 a.m. tomorrow. What would be the best possible print to actually maybe breathe some life back into the bull market?
So I do think that it's hard to know what is going to please this market. To your point, we have half the folks looking for a weak number that pushes Chair Powell to go 50, and the expectation is that that's the good news. Alternatively, you have half the folks saying, look, if we're really going to get a soft landing, that means a slow Fed and a stable labor market where consumption holds up. So look, we're in the soft landing camp. We're looking for a solid jobs creation number. Hopefully we come in right at the consensus, and that means a market that starts to broaden, right, and suggest a Fed that is going to be measured and go somewhat slowly. That may not be great, for some of the, the tech high flyers, which have started to swoon a little bit. But it should be, decent news for, the core of the market in financials, industrials, and energy stocks, for example, that should do well if we get this slow and steady, moderate soft landing.
Lisa, what about a slow and steady rate cutting cycle? At the end of the day, there are a lot of doubts that are hanging around that a 25 basis point cut, or even 2, or even 3 for that matter, in the next, let's say, 3 to 6 months, would make much of a dent in then moving some of these consumption numbers forward, given the weaknesses you're already seeing in the labor market. How much do rates need to go down to really stimulate the economy?
Yeah, so this is, I think, one of the biggest controversies because, this has been an economy where higher rates have had an impact, or the rate sensitive parts of the economy have been much smaller than historically and very concentrated. And so the question of whether a slow and steady Fed or a soft landing Fed is going to help housing, whether it's going to help small businesses, whether it's going to help the low-end consumer, whether it's going to help commercial real estate, I think the jury's out on that. And what that might mean is if we get a soft landing, we have a mix in the market that's very similar to what we've had over the last couple of years, and small caps don't catch up, and we don't see a big cyclical trade, if you will.
So it is the small caps, it is the cyclicals that you expect to react most favorably to rate cuts. I was going to ask, in terms of industry groups, which sectors do you want to be long if you say you had a crystal ball and you knew they were going to cut 50 basis points?
Yeah, I think kind of the bigger the Fed goes early, the better that's going to be for recharging, the more cyclical, more small cap, more rate sensitive pieces of the market. Again, our view is that the Fed's probably going to be slow and deliberate. And that may be painful for some of the folks, who are looking to employ the traditional quote unquote rate cut playbook.
And Lisa, with your role as Chief Investment Officer, I'd like to get your cross-asset view right now, because especially earlier in this week, we were worried about that yen carry trade unwind again. That was used to maybe explain some of the jitters that we were seeing, especially in some of the big cap tech stocks. How much weight do you put in that argument? I mean, is this a real force in this market, or are we perhaps using this as a scapegoat?
No, we believe that it has been large and it is a real force. It's more of a technical positioning force, but it is not, that trade is not fully unwound. And so I do think that this is going to be a lingering pressure until we get more clarity on the pace from the Fed. And so it is a risk that is out there, and that risk probably contributes to volatility and plays out in terms of vulnerability for some of the most richly valued parts of the market, which, as we know, has been in tech.
Lisa, there has been a lot of conversation about concentration in this rally into those large cap tech names for the majority of this year, much of last year as well, from what I remember. So on the way down, what does that look like? If the concentration has been loaded into those names, then is there a risk that those names can see a bigger drawdown?
Absolutely, right? These trends tend to cut both ways. And so one of the things that we've talked a lot about with our clients is the value at this point in the cycle of potentially moving away from that market cap weighted index, where those concentration dynamics have been so profound, moving more to an equal weighted index to mute what could be a little bit of an outside sensitivity on the way down.
Lisa, great having you on the program. Thank you so much for joining us. Lisa Shalett there, Morgan Stanley Wealth Management Chief Investment Officer. Quick check on futures. As we head to break, we are looking at unchanged S&P futures, but that masks the volatility that we saw this morning when the ADP jobs number came out. We saw a big drop and then a recovery after the initial jobless claims. NASDAQ futures still off almost 1/3 and Russell 2,000 futures up. Let's get a look at some of the stocks moving ahead of the opening bell. For that, we go over to Abigail Doolittle. Abby?
Well, let's start off with the stock that's really tumbling here in the pre-open, pre-market. That is C3AI, down about 20%. Now, there's a big bearish short interest on this stock, but what happened here was, despite the fact that there was overall revenue growth, it was due to services, not software. Software subscriptions came in light, and therefore this big move lower. But again, lots of bears already on that stock. Now, speaking of AI, if we take a look at the shares of Hewlett-Packard Enterprise, we're going to see that they're down 5.4%. The AI contribution to the quarter that they just reported, it was strong, but it was offset by margins due to weak server business. Therefore, investors right now selling that stock down 5.4%. Intel is also lower. This as we have the Airstate Group cutting it to a sell. This is one of 6 sells. There's 37 neutrals, and then there are 7 buys. Overall, this stock down 60% on the year coming into today, having to do with the company having a hard time getting things out of neutral, I would say, and really turned around. Let's end on a bright.
37 neutrals.
Yes, 37 neutrals.
Go ahead and say sell. They afraid they're going to hurt somebody's feelings?
Then what's the point of covering the stock?
They're not quite brave enough, and maybe some banking relationships that they're hoping that there could be, and then, who knows, maybe the rating gets boosted to a buy. And then a real bright spot to end, and I'm interested for your thoughts on this, Matt. Tesla up 2.7%. They are, of course, launching an advanced driver assistance program in China and Europe in the first quarter of next year if it gets approved. And then there's also a story out that they are about to provide winter tires for the new Cybertruck. I will say I saw one in Westchester the other day. Matt, was that you?
No, I have not yet driven a Cybertruck.
I love the Cybertruck.
You have to get one with winter tires.
I find them to be heinous, but I admire the company for going ahead with it. Like no other company in the world would make that thing.
I need a Cybertruck podcast from Matt and Hannah.
Hannah drove it, and tune into my podcast, Hot Pursuit, with Hannah Elliott. You can find it on Apple Podcasts or wherever you get your podcasts. Abigail Doolittle, thanks very much for that. Coming up, a skepticism rising about the AI trade on Wall Street. We're going to go over to the left coast and talk to Ed Ludlow, co-host of Bloomberg Technology. Broadcom's coming out with earnings. That could be a reset. This is Bloomberg. Let's get to high interest to look at what's making headlines around the world. French President Emmanuel Macron picked Michel Barnier as the country's new prime minister. The decision follows months of political uncertainty in France after a snap election didn't deliver a majority for any group. Barnier now faces the challenge of forming a new government in a very mixed political landscape. And Samsonite has selected JP Morgan and Morgan Stanley for its dual listing in the U.S. The luggage maker is looking to improve its liquidity and draw more investment globally. Other banks are also looking to join the lineup. Samsonite, which currently trades in Hong Kong, may make the U.S. its primary of the two listings. Plus, actor Matt Damon and Lin-Manuel Miranda, the creator of the hit Broadway musical Hamilton and like a million other super successful projects, will appear at a campaign fundraiser for Vice President Kamala Harris in New York City this month. Tickets for the dinner are going for $25,000 a head. The Harris campaign has been leaning on celebrities such as Anna Wintour and Oprah Winfrey as she looks to expand her cash advantage over the Trump campaign. Sonali?
And we're going to check in, Matt, now on AI stocks, because today, after the bell, we get Broadcom earnings with the focus on its full-year guidance. Meanwhile, C3 AI is plunging after reporting quarterly subscription revenue that missed estimates, and it's down more than 18, almost 19% pre-market. NVIDIA is holding steady after a whirlwind week after news of an antitrust investigation and concerns around its valuation. Let's discuss it all with Bloomberg Technology co-host Ed Ludlow, and perhaps we start with Broadcom for no other real reason than it's like the next catalyst here for this market. We were kind of pointing out yesterday that over the month, you really had almost every stock in the Philadelphia Semiconductor Index down over the month. Where's the sentiment headed into Broadcom?
Yeah, with Broadcom, there's a lot of hope. It is a big chip maker that's making headway in the market for AI-related data center gear. You know, NVIDIA dominates the market for AI accelerators or the GPUs. But Broadcom basically has two parts to its business, chips and software. And within the chips division, it's kind of a split in two. One where it provides really important gear for data centers, largely for data center networking. But it also has a custom silicon business. For example, it works with Google on Google's TPU. And there's an expectation it will upgrade or up its forecast for AI-related sales, and a part of that is whether it onboards other customers for which it works with them on custom AI-related silicon or ASICs.
Well, Ed, that's what I was going to ask. What is going to be the focus of this print? Because you mentioned, of course, that SalesView, they could upgrade it. Of course, they onboarded their third customer. There's, speculation that a fourth could soon be imminent. I mean, is that really what people are going to be paying attention to tonight? Yeah,
a new custom chip customer is sort of the idiosyncratic thing that the market will get excited about with Broadcom, but any sort of refresh or boost to its commentary on AI-related sales is kind of the story still, right? Is the investment cycle in AI intact? And again, if data centers are getting built specifically for AI-related compute, logically Broadcom would have a part of that. So there is a bigger picture signal that we can take if there's a strong print.
We've really seen the premium of all these big mega caps tech stocks, Ed, come back down closer to like an equal-weighted S&P. Do the investors that you speak with out on the West Coast just have a little bit less enthusiasm as earnings from these companies, still very strong, slows down to sort of catch down with the rest of the group?
Don't know that they're losing enthusiasm. I think the line that gets repeated over and over, particularly those that hold significant volume of NVIDIA shares, is we are long-term investors. And they look at the life cycle of a data center, the dollars it takes to build a new data center or update one, how long it takes, and the new generations of technology coming online. And they basically say, we believe that the long-term story is intact, but we note in the short-term volatility because of the news headlines.
Speaking of the news headlines, and when we think about NVIDIA this week in particular, of course, a lot of sour sentiment around the stock for a few reasons. But then you have this headline as well about NVIDIA and other investors looking to back Applied Digital. And I'm interested in this because it's not just NVIDIA, it's also reportedly related companies. So other private investors really getting in on the boom as they said they would, but now in conjunction with NVIDIA. How significant is something like this? We've seen more of it.
Yeah, I mean, one thing I would say is that you see a lot of traditional venture or private growth equity names muscled out of the market because the mega caps themselves have on their balance sheet R&D spend, which is significant, or they have venture arms that push people out of rounds. There's a lot of focus, though, right now, for example, on NVIDIA and the investments it's making in private companies along the way as part of its strategy to do more than just make GPUs.
All right, Bloomberg Technologies' Ed Ludlow, thank you for that. And it's a busy day for Ed and Caroline Hyde. You can catch their interviews with the CEO of C3 AI as well as the CEO of Verizon following the company's takeover of Frontier Communications. That's coming up at 11 a.m. Eastern on Bloomberg Technology. But coming up on this program, Delta Stumble is giving JetBlue new wings. Details in Social Climbers coming up next. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. 20 seconds to go. And in terms of futures right now, not a lot of movement on the S&P, basically completely unchanged. NASDAQ futures are down and Russell 2000 futures are up. But there has been a lot of volatility this morning. When you had the ADP number come out and showing a weaker labor market, we had a real dip in futures. Then we had initial jobless claims come out bang in line, and we came back up. We're still about 120 points away on the S&P 500 from an all-time record, but it's only 120 points, right? We're at 55.20 or thereabouts. Let's get over to Katie Greifeld right now. She can give you the exact numbers in the first minute of trading. Katie?
Yeah, and there's not too much movement on the screen beside me. You can see, of course, the S&P 500 just about flat. That in and of itself is interesting, though. You think about all the economic data that we've gotten this week. Of course, that huge down day that we got on Tuesday to start off September. And right now, maybe taking a little bit of a breather. A slightly different story if you take a look at the NASDAQ 100, currently off by about 0.3%. Of course, big tech has been your big loser this week, and that holds this morning as well. And if you're looking for a bright spot, you're going to find a really small one in the small caps. The Russell 2000 index currently up about 0.2%. Now, some stocks to keep an eye on this morning. Let's start with Verizon, agreeing to buy rival telecom company Frontier for about $9.6 billion in cash, really looking to improve its high-speed internet offerings. Now, this deal, it represents a 37% premium to Frontier's closing price on Tuesday. What's interesting, though, you look at both stocks pre-market, both are down. Frontier even more so. Not usually what you see from the company being acquired, Sonali.
You sure don't. I want to talk about another deal here because you are seeing an opposite reaction. Applied Digital shares just surging after the company said that it had raised $160 million in funding from investors, including NVIDIA. Applied Digital is up more than 41% as the market opens. Remember, this is a stock that before today was down almost 52%, and the market cap heading into today was only 500 million or so. So 160 million goes a long way. Matt.
Yeah, absolutely. Worth now about $700 million in market cap. I shouldn't have said it was a penny stock, but, you know, it's a small cap, we'll say, for sure. Checking in on shares of the exact opposite of that, NVIDIA this morning. That company grappling with growth concerns and an antitrust probe here in the U.S. Do we call it a subpoena? Do we not call it a subpoena? I guess it really doesn't matter because the shares are trading for $105. Take a closer look at the AI trade with Bloomberg's Abigail Doolittle. Abby?
Yeah, Matt, I think we ignore the subpoena, whether it's a subpoena or not. That's not the real story here, at least to the best of my ability to determine. It really has to do with the fact that this stock was up so much earlier this year on those blowout numbers that they had put up for quarter after quarter. But last week, it was a good quarter, but it wasn't a blowout quarter or a blowout guide. So over the last 6 days, you can see shares down about 18%. This is the worst stretch for NVIDIA going back to September of 2022. I would argue more of this has to do with too far, too fast investors getting out in front of their skis without knowing that those blowouts would continue continue and that they would soften a little bit in the quarter that was just reported. Plus, sequentially, even though the numbers are massive growth on a year-over-year basis, sequentially they're down more than 50%, or at least that's what was just reported. When we put this together with the chart, there's a bit of a startling picture here. Now, this is an interesting chart, lots of color on it, but you can see the big uptrend out of the October 2023 lows. This is that range we've been watching. It made it to the top. Now we're going likely to the bottom, which is below 100. The importance of a range, though, is not the range itself. It's which way it breaks. The fact that this range is breaking the uptrend as shown in these waves suggests that we're very likely going to hit down to the third wave around 70, or possibly the entire area, if it were to break to the downside, would take us right back to the 2023 lows, which is around 40. This chart suggests that there could be some real bearish action ahead for NVIDIA. We don't know that, but that is the suggestion. It's been pretty good up until now. But, you know, a piece of it, Katie, of course, I was talking about that too far, too fast. NVIDIA, even with this decline over the last 6 days, still a double on the year. And then take a look at the overall chip and AI space. Very, very strong year to date.
Yeah, of course. It's important to remember that we've come very far so far this year, even though the last month or so has felt pretty ugly. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina, joining us at the desk. Lori, great to see you again.
Great to see you. Thanks for having me.
So I don't need to tell you that it's been a pretty bruising start to September,
Yes.
I think is fair to say. You think about this market really on tenterhooks when it comes to growth scares. And then you look ahead, of course, to tomorrow's jobs report. I'll ask you the same question I asked to our 9 a.m. guests, and that's what do the bulls actually want to see at 8:30 a.m. Eastern tomorrow?
So look, I think that, you know, there's a debate over where the unemployment rate is going to go. Even at RBC, our data science team thinks it's going to go to 4.3. Our economists think it's going to go to 4.2. So, you know, there's a real debate on, you know, kind of how much it's going to go up, right? And I think that the bulls really want it to go up enough to keep those Fed cuts on the table, but probably just want consensus to be met at this point, right? I think all along, part of the Fed cutting thesis was we need to soften the labor market a little bit to get some of those inflationary pressures off. Well, be careful what you wish for. We've got it. And now we're worrying it's going to go a little too far in the other direction. But I think just really threading that needle is what the street wants to see.
We are focused on stocks right now. Obviously, we just had the open, but I want to get your economic perspective on what a rate cut really does for this economy. I mean, even if it's 50 basis points, does that change the housing picture? Does that impact car buyers?
Look, I do think that you have seen recently just a lot of weakness percolating in that auto segment in particular. We heard about this back in May at the RBC Consumer Conference, and you were starting to hear it around the same time in company earnings reports. So it does seem like that's suddenly come on, and something about sort of where we've been in the very, very recent past has kind of hit a tipping point there. So maybe you could get some improvement there. You know, I know our data science team, they have some different data points they monitor on housing, and they do see when interest rates come down just a little bit that you do see sort of a spike in searches. So, you know, it could help, you know, I would say in terms of sentiment at the margin. But I think you're right. I mean, we are sitting here at a very high level of rates. It's going to take them time to get down. It's going to take time for that to feed into the economy. But I do go back to the idea that while this economy is clearly softening, you know, we're hitting some potholes here and there, it does seem to be pretty solid under the surface. So I do think we have some time.
Lori, what does a landing look like? And is employment really the only way to look at it? We stand here today and that 210 curve has lost its inversion. It is disinverted. We have met that moment, but what's the road ahead looking like?
So I would say, you know, if I'm just sort of I know people have put out their different definitions of soft landing on GDP and other things like that. I mean, I would like to see it stay above 2%. I think that, you know, 0 to 2% is typically a weak environment for equity markets. So from my seat, I really need it to sort of stay above 2 to have the market believe that we're not on the precipice of a recession. I'm also looking at consumer confidence really closely, and specifically the Michigan Sentiment Survey. There has been a really weird positive correlation between year-over-year trends in S&P 5 and Russell 2000, and then just that Michigan sentiment data since 2021. We are in oddly just this, and the correlations are like in the high 80s, low 90s. It's really weird. It's unusual. It's not something we saw pre-COVID, and it just tells me the market is so much more sentiment driven. And if you think back to 2022, we saw sentiment plunge to recession-type lows, and that took the market down with recession-type pricing. So I think it's not just about the GDP data, it's not just about interest rates, it's also, frankly, about how people feel.
Well, that kind of brings us back to, again, what does this market want to see? It is a very sentiment-driven market. We're past, you know, the bulk of earnings season. Now it's just the macro environment, and this is a Fed that's trying to cut rates here, and the point has been made. I think it was Mike Wilson over at Morgan Stanley saying that a 50 basis point cut probably would spook markets at this point, and we're really pricing in it's like a razor's edge.
And look, I do think you can sort of make the argument, if I take the counter, right, of my own view, right, because I agree with you and Mike. Like, I think that 50 basis points spooks people. I started in the business in 2000. We get these big chunky cuts or surprise cuts. It's not good. It's for a bad reason, right? You can go back prior to my experience. You can go back in past cycles and find examples of bigger cuts. I don't think that's really the market's muscle memory here. I do think that, you know, we're just living and breathing every single employment print the same way we were breathing every inflation print, you know, 6-9 months ago. I think that a lot of people I talk to in my seat, right, equity PMs, they're listening to what companies are saying. And apologies to the beige book, but they're not really reading the beige book, right? Like we're
going, not there yet.
Right. I was really puzzled by the reaction to that yesterday. But at any rate, they're looking at companies, public companies, and what they're saying. And we're not seeing public companies talking about layoffs right now. They are slowing hiring, but we're in this weird era where they have found all these other ways through technology, automation, maybe one day AI, it's not quite here yet, but to cut costs and maintain margins. That is very different in the post-COVID era. We've been really seeing that since kind of 2016, 2018. They can use all these technological tools to cut costs before they cut labor. But if we start to see companies go there, I think that is going to really concern
I keep
markets.
trying to wrap my head around there's so much pessimism on the economy, right? And yet we have growth at 3%. Unemployment is 4.3%, so higher than it was, but still much lower than the historical average, right? Which I think is like 5.6. And if we get a good print tomorrow and we're back at 4.1%, I mean, it's not all about cutting costs, boosting margins. Sales in the last earnings season were 5+%.
Yeah. No, I think underlying the surface, right, I think things are still very solid. And there was one retail company that said in the last couple of weeks, I was out in late August, I was kind of playing catch up on earnings the other day, but there was one company that just said very plainly, we still see the appetite to spend. We still see that willingness to spend, right? People are fed up with inflation. They're looking for value. They're more selective. They're more choiceful. I'm in that camp too. I have little kids. I mean, we're buying back to school stuff and I'm looking for the cheap shoes. So I get it. But the reality is that while the jobs are still there, that spending power is still there. This is weird psychology we're dealing with post-COVID. And I do think that at the end of the day, while the jobs are there, we're going to muddle through. And that's why we are all breathing in that data so closely.
Weird psychology. We're going to talk about weird market moves next. Lori, stick with us. Coming up next.
We're going to get weird today, huh?
I'm all about the weirdness. Stick with us. Coming up, BMO says disappointing earnings from the Dollar Tree was the last straw. Details on that next in today's Top Calls. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, BMO says that Dollar Tree no longer a buy. The firm says that the discount retailer's bleak earnings report was the, quote, final straw, and says that there's growing risk that its valuation could fall further. Next up, Wells Fargo says that Roku no longer a sell, upgrading the streaming video platform to equal weight, also raising its price target, citing the potential in the company's Roku channel service. And finally, RBC giving KB Home a sell rating. The analyst sees more near-term challenges for the home builder thanks to softer macro data in the housing sector. Sonali.
And we're back with RBC Capital Markets head of U.S. equity strategy, Lori Calvasina. And it's interesting because you have the Philadelphia Semiconductor Index, which has NVIDIA in it, of course, just flying most of this year. But as we started September, actually every single stock is in the red. It's absolutely incredible. You have every stock at least down 4% or more, the whole index down almost 8%, and Intel being the laggard with a more than 11% drop. What is this? Is this a change in sentiment or a valuation reset? And if it's the latter, how far can this redness go?
I think it's both. So we have these industry models that we look at. It's across the market cap spectrum. We look at the Russell 3000, but we look at the rate of upward revisions for the broader semi group. And then we also look at the median PE relative to the broader market. And what's interesting is that if you take the tech sector, the semi and semi equipment group is the only one that's in the red on the grid. And what I mean by that is you've got both negative revisions and you've still got expensive valuations despite the pain that we've already seen. So we updated this, I think, on Tuesday for last week. week's close. So even, with all the pain we've seen there, we don't have the valuation opportunity yet. So exactly how far lower it can go, I mean, quite a bit, right? Like often these things will kind of go to one standard deviation below the long-term average, and we're still above the average right now.
Well, what does this mean, Lori, in terms of why we're seeing those revisions? Is it just not materializing that companies are using AI or investing in AI at the rate that we came into the year thinking they would?
So, I think on the AI theme, probably the most interesting comment I've seen recently came from one of the software companies, and they had this, I'm going to mess up this quote just a little bit, but they said something like, don't DIY your AI, like don't do it yourself. Yeah. And they were sort of lamenting, with their customers, all the wasted spend that had been done in this first tranche. And, so it sort of, I'm certainly not an AI expert, right? But I read into this saying, okay, there's been a lot of money that's been dumped. It hasn't necessarily been spent smartly. And one of these companies, right, who wants to do all the spending and do all the work for these other companies is trying to call them out on them. So they're talking their own book a little bit, right? But I thought it was interesting because I do think there's been this sort of impatience, right? We want to see the results here and now. And if you haven't done that initial tranche of spend smartly, it's going to take more time for those, benefits to come into play, which at the end of the day, should still argue, right, for continuing to ramp up and build out the technology. But if there's been sort of this first round of disappointment, I think that helps explain, why there's been kind of this loss of sparkle on that AI theme as much as any of these other things we talk about.
Yeah, clearly patience starting to wear thin among some investors. Lori, I do want to switch gears and talk about politics. Of course, we are counting down to the election. There was a really interesting note out from Goldman today talking about, if you take a look at the different tax plans of Trump and Harris, when it comes to S&P 500 earnings, the impact could be in a ballpark range of 5 to 10%, depending on who actually wins. Now, I won't ask you to get that specific, but I am curious. I mean, a lot of people talk about the Trump trade, the Harris trade, et cetera, but when you think about their actual proposals here, how are you thinking about the long term?
So I think we have to be careful. The devil is in the details with some of these things. And Matt and I were joking earlier. I think I have PTSD from the Trump corporate tax reform that we did previously, because I think that it was discussed for over a year. And what I remember about that period, right, was we had all these companies. People sort of figured out the smaller cap companies are more direct payers of rates, right? So they benefited more from the number coming down, and people figured that out and pre-traded it. But what I really remember is when I was talking to the analyst community, the people who cover companies, a lot of people told me they're like, even after the legislation was passed, right, and you knew what the number was, they're like, we still don't really know how to model this. Like, we have to talk to our companies, and the companies are telling us they have to talk to Treasury, and they have to get guidance on all the implementation. So I think, people like me, we can go in, we can plug in, numbers in our model. The S&P effective tax rate, by the way, has been trending around 19%. It's been going up in recent years because of some of the foreign issues. So it's not even just as simple as the U.S. rate, but we can go in, we can change those numbers, we can come up with estimates. They're just guesses at this point, right? So I wouldn't tell people to really get overly excited about that kind of stuff at this point in time. We need the laws to pass, we need the regulations to be issued, and people to go out and do the work. By the way, it mattered for a little while. It was pre-traded. Even when all those regulations came out, the impact on the market was less. So, and it tended to be viewed by investors as this kind of one-time wonky thing that didn't really affect the business. So yes, it will affect headline earnings numbers and multiples and that kind of stuff. We might be over, emphasizing the importance at the end of the day.
I wish we could keep you longer, Lori, but I hope we can get you back soon. Lori Calvasina, their RBC Capital Markets head of U.S. equity strategy. Coming up, Verizon agreeing to buy rival telecoms operator Frontier for around $9.6 billion. But the target falls after the announcement. That and more in our Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market about 22 minutes into the U.S. trading day. You can see we're pretty flat on the S&P 500. The NASDAQ 100 actually poking into the green right now, up about 0.2%. We know it's been a brutal short week so far, but a little bit of relief today. Meanwhile, on the other end of the trade, you have the Russell 2000, your small caps. They were higher, now they're not, down about 0.1%, Sonali.
And it's time now, Katie, for the Wall Street beat. We're going to look at some things moving under the surface. Verizon agreeing to buy Frontier for about $9.6 billion. The New York phone giant is looking to expand its high-speed internet business. And it's fascinating because the transaction, including debt, is $20 billion. This is a cash transaction. We love to see these cash transactions. Nordstrom yesterday was also cash. Yet you have Frontier really taking a hit today. What is really happening? Is there uncertainty around this deal?
I haven't heard about any regulatory uncertainty here, although it definitely, will need approval. But Frontier's an interesting stock. It went bankrupt just in 2020, and some Wall Street names like Ares and Cerberus are investors. So maybe, there's like a liquidity issue of some kind. I've also heard that other transactions in the fiber space maybe have traded at a higher multiple. So, it's unclear if we're going to see a bidding war for Frontier. So maybe that's why shares aren't up, but we'll look into it today.
To me, the most fascinating deal right now is the Nippon Steel attempted takeover of U.S. Steel, because both parties are determined to block this Japanese buyer coming in and essentially saving U.S. jobs. It's so weird, right? How is this going to work out if a Nippon Steel really is blocked? I mean, are there any American buyers for it? Could it be private equity?
So Cleveland-Cliffs was a name that we were all watching. They were involved in the bidding process last year for U.S. Steel, but now we're not sure they'd buy the whole thing. I'm sure the CEO would love to pick off bits and pieces. So this is a really tough position for U.S. Steel, and we do expect the White House to block this deal on national security grounds. And it seems to be the one issue that all politicians agree on, that this deal shouldn't happen.
And I mean, sticking in Japan, let's talk about the owner of 7-Eleven and, of course, Couche-Tard. What's going on with that deal? It seems like they've not quite aligned when it comes to the price.
So overnight, we saw the price leak out. We were wondering for days, what had Couche-Tard actually bid on 7-9. It looks like it's around $15 a share, which is not really a knockout offer. And in yen, you could see that the shares, aren't trading much higher than that. So from the beginning, 7-9 has been really defensive about potentially selling to Couche-Tard. And, this news kind of shows that this deal is not happening anytime soon, but we'll still be watching to see how Couche-Tard responds. And I grew up in Quebec, so I'm watching this also really closely because it's big for Couche-Tard.
Liana, like 20 seconds here, but as the leader of a deals team here, are you surprised with the velocity of activity we've been seeing?
So it's a bit of a takeover Thursday. Sometimes, after Labor Day, we think there's going to be a big deal Tuesday, and we didn't see that. So it seems like it was a little bit delayed. But 2 of the 3 deals we talked about today are about deals maybe dying or not happening. So really the big news today is Verizon Frontier, which it's great to see something $20 billion enterprise value get to the finish line.
All right, very cool, Liana. Thank you so much for joining us. Liana Baker there runs the deals team for us here at Bloomberg. Just a programming note on Verizon. The CEO, Hans Vestberg, will be joining Bloomberg Television today at 11 a.m. New York time. We'll all be watching it very closely. You should, too. Coming up in the next hour, HSBC's head of wealth and personal banking, plus e.l.f., eyes, lips, face. e.l.f. Beauty's CEO. And the founder of a new CFO, and the founder of a new sports-focused real estate firm. Jonathan Fascitelli joins us around a really interesting story. Will the 76ers actually move from Philadelphia
to New Jersey?
Camden, New Jersey? We'll ask him. This is Bloomberg. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
We are waiting for and just getting ISM services. No, not yet. ISM services
4 seconds.
Data. 4 seconds to go. Here we go. Breaking news. 51.5. So pretty much in line with the expectation. We were looking for 51.4 in terms of prices paid, a little bit higher than we were looking for at 57.3. We were looking for 56. The employment number in line at 50.2. We were looking for 50.5. And new orders at 53. So a little bit higher than the 51.9 that we had been expecting. Michael McKee, Bloomberg's chief international economics and policy correspondent, standing by with his read on these numbers. So, Mike, it's not bad, right?
No, it's not bad. It suggests that the economy on the service side is about where it has been for the last many months. We don't see any deterioration there. New orders do rise, which is good news, and inventories have risen somewhat. The prices paid number is little changed, so no inflation in that. I think everybody is looking at the employment number, though. The employment number in terms of plans for hiring falls to 50.2 from 51.1, still above the 50 rate that implies contraction, but it is lower, and that does suggest that perhaps we have a bit of a downside risk in services tomorrow in the non-farm payrolls number. We saw the same thing with ADP. ADP had a low services industry gain, the lowest in 6 months. So when you put the two things together, that implies something of a downside surprise, and I would not be surprised if we see some people revise their forecast for payrolls tomorrow, and maybe that consensus goes down a little bit.
All right, Mike McKee, appreciate that. Of course, a busy week for Mike McKee. We have a lot of economic data. You take a look at the S&P 500 in the wake of what we just learned about ISM services. We're actually at session highs on the S&P 500, currently up about 0.4%. The bond market yields rising a little bit. The 10-year currently camped out at about 3.74%, but of course, still lower on the day. We do have some movement in the oil space as well. Some breaking news there that OPEC Plus has a deal to pause a planned oil hike for 2 months. This is according to a delegate. You take a look at what oil is doing. I'm taking a look at what's Texas right now, and you can see we're up a little bit, up 1.3% on the day. We're just at $70 a barrel there. Of course, we've seen a big downdraft in oil, a little bit of a rise higher here. But let's broaden out this conversation now and bring in Racquel Oden. She is HSBC Head of Wealth and Personal Banking, joining us on set. Great to see you.
Good morning. Thanks for having me.
So it's been a rocky couple of months, a rocky couple of weeks, of course, and this market is really mono-focused on that jobs print tomorrow, as everyone seems to be nervous about growth concerns here, growth scares. What are your clients, what are your investors asking you right now?
Yeah, it's a really great question. And I think, as you heard from each data point we saw today, every data point matters right now. And if we think about what we historically have seen in September and October, we do know we tend to see challenges or volatility in the market. So one thing we are telling our clients right now is bear for volatility. That's what we can expect to see over the next couple of months, and that's historically normal for September and October. But additionally, you add some additional things like a really important election that's coming up, and you add some additional things, which is the balance of inflation versus recession. So it points us back to that important statement, which is around where are rates going? And that's what everybody continues to see as the primary indicator of what is the Fed going to do.
If you're bracing for volatility, Racquel, what does that mean at the end of the day? Does that mean hold on to your cash? Does it mean buy the dip in some instances? Or does it mean hold out until you see those buying opportunities at the end of, say, a 3-month horizon?
Yeah. What it means is stay invested. I start there. I think that's very important. The additional piece, what's important about that is, of course, everybody would like to buy low and sell high. So when you see this volatility, there's opportunity for individuals to step in, but more importantly, stay invested in the market. And that's the really part that we try to balance in all of this. Additionally, what's also important, if you think about the individual investor, the reason why we feel this way is, we talk about when we take a look at what we're looking at, when we at some point reference the interest rate changes that could be coming, and we should talk about what we think that should look like. But what we've generally sensed and seen, which we tell our investors, is we're expecting a fourth quarter rally. And that has been a historical truth. But additionally, why we think that's important is we look at, what's actually happening with corporates. If we take a look at what's actually happening, they're up 10% this year, and we anticipate another 15% up next year for margins. So ultimately, stay invested. There will be a little rocky period, but we really do believe there's a rally at the end of the year.
I mean, it does seem like you can make an easy call directionally. There's volatility accompanying the size and timing of rate cuts, but you know that the Fed is going to start cutting. The carry trade is important, and it's not, but it gets equaled out. The only question mark is who wins the election in November, right? Because we know that if Donald Trump is able to put in place higher tariffs, keep tax cuts, deport millions of people, that's going to have real inflationary effects. And I'm assuming that inflation is probably one of the #1 concerns for your clients.
Absolutely. Inflation is the #1 concern for our clients, #1 concern for all individuals if we think about it. And really what you want to do is you're looking to the Fed to figure out how do we do what I call the slow easing. And ultimately, we could say there is going to be an interest rate cut. The debate we're having right now is just how much.
Well, if Trump gets into office, he's going to want fast easing, right? And he's going to want to say in interest rate policy.
Either way, the way I look at the elections, which is very important, we know that after any election, no matter which side wins, we always see equity markets rally. And so back to individual investors, don't get caught whether Trump or a Kamala wins. It really is the fact that we always see a rally after elections, and that's the key.
And to be fair, we don't know how the Fed is going to behave under a Trump administration. There's a lot of concerns about that independence.
Also, what's the stat we keep trotting out that in like 50 of the last election cycles, I'm exaggerating, that the S&P 500 has gone up 95% of the time? So
that's my point.
History's on the side of long-term bulls here.
11, I think, of the last elections. The market was up 6 months later.
Energy was bad for Biden, but Biden drove it to a record too. I don't know, Katie.
Yeah, so who really
elections
knows?
work for us is what we would say. It's really important to know that you tend to see a rally after an election. And so all of that with the equation of what the Fed does in September will be important. Our prediction right now is at least 75 bips by the end of the year, whether it's 2 cuts or 1 cut or 3 cuts. I think the debate everybody's having right now is if we see that 50 bip cut in September, does that indicate recession? So the Fed's got a hard balancing act they got to figure out right now. But ultimately, rates will go down. The question is, how soft will that easing be?
Right.
Will it be big cuts or small cuts? So again, it's back to how much, not if there'll be rate cuts.
Well, talk to us about how you think a 50 basis point cut in 2 weeks' time would actually be received by the markets. Because you do have Neil Dutta at Renaissance Macro pounding the table saying that the Fed should go ahead with 50. But then you have the Mike Wilsons of the world saying that would actually really spook markets at this critical juncture. What's your view?
So my view is I think no matter what they do, they're going to spook markets a little bit. But I think ultimately 50 basis points would actually indicate recession, right? It would say something's really wrong. The 25, which everyone's expecting a rate cut, would be more in line of that easing of interest rates versus giving the alarm that there could be a recession. But ultimately, that's why I point to the 75 basis points by the end of the year. Right? Whether it's 50 first and then 25, ultimately you end at 75 basis points.
Another conversation we've been having a lot is what do you do in that scenario? Right now, you've had a lot of people move to cash. People are very excited about what you have gotten back from sitting in cash. And if you only expect 75 basis points for this year, why not stay in cash?
Well, as we all know, cash will continue to earn you less, right? And so the important piece here is what we'd say is post-COVID, there's $4 trillion in money markets, right? So there's an opportunity that says equity and markets are going to do very well. Individuals are seeking yield, and yield will not come from cash. We have to understand that, just basically what's happening with interest rates. But importantly, that's where equity markets and getting into the markets are going to be really critical for our investors. So rate cuts are coming. That's a given. So cash needs to work, and cash needs to work in the markets.
You know, Sonali was freaking out about the 2-year yield coming down below 3.70.
I screamed in his ear this morning.
We sit next to each other.
Yes.
And I keep hearing these lower and lower rates numbers and worrying that I've truly missed the boat. Do you have clients concerned about the same thing? I mean, I would have loved to lock in 5% treasuries.
Well, that's why you're going to go into the markets. It's never not the right time. So the question is really sitting down with your advisor and figuring out what's best. You want your cash to work for you. You want your investments to work for you. But I always tell our clients, it's about the long term. So you'll see these moments of volatility. You will see things like elections come and go. But ultimately, you're focusing on retirement, and you're focusing on how you send your kids to school. And so you have to think long term. Again, we've got to think about also affordability for individuals right now. So we're not denying. It feels inflationary, right? The cost of eggs, the cost of steak, the ability,
the cost of cars, the cost of homes.
Cars.
I mean, affordability is gone.
Affordability is a real concern. And so what's going to be important is the administration tackling that versus the debate about where interest rates should go. But how do we now focus on affordability for the individual consumer?
Well, how many rate cuts is that going to take? That of 75 basis points, I mean, that gets us in the right direction, but we're still restrictive. We're still not close.
Most people are sub 4% still on their mortgages. What does 6.5%?
So in this environment, I mean, what is neutral?
Yeah, so I think 75 basis points this year and the continuation into 2025, at least another 75 basis points. So you're going to continue to see that easing. What that will do, as we know, to the mortgage market, it allows people to be able to buy homes again, at least with a better interest rate, right? And so that will take time to ease, and that's why continued cuts are going to be important, because you don't feel the cut right away, especially if you go at that 25 bips. They're small cuts, so the consistency of that over this year and next year will be important for the individual consumer to feel more engaged in the ability for them to, one, feel like affordability is something that they can use as a parameter of feeling better about this economy.
Sure, there are tons of people out there, not going to name any, but they want to refinance their mortgages, I've heard.
Well, did you see Howard Marks' comments yesterday? He thinks that rates are going to go down to 3.
Yeah, but not below. But not below.
And
anyways,
that's a refi boom. That's what that becomes.
Yeah.
So.
Racquel, we thank you so much for being here with us in studio. That is Racquel Oden, HSBC, Head of Wealth and Personal Banking. Now let's get a look at stocks moving this hour. Here's Abigail Doolittle. Abby.
Well, we do have the shares of Ford popping. They did report August vehicle sales. Actually, it had been popping. Now it's about down 0.2%. It had been up about 1% after they reported that they sold roughly 183,000 vehicles in the month of August. That was up 13.4% on a year-over-year basis. Trucks, the better half or the better part of those overall sales, up 12.3%. We'll be watching as to why investors were initially pleased with that and then not so much now. Turning to some of the M&A deal, and I was just looking at the numbers. It seems as though there's mixed reporting, so I'm going to go with Bloomberg's reporting on this, that Verizon is buying Frontier Communications for $9.6 billion. Another news source is saying that the number is much larger. What's so unusual, and Katie was pointing this out earlier, is that the acquired company, or the potentially acquired company, is down. This price represented, the one we are saying, represented a 36% premium, down 9.4%. That's the worst day in more than a year. Maybe this suggests that in this strong antitrust era, investors think this deal won't go through. It's unclear, but this is another story, of course, we'll be watching. And then to end on a big bright spot, let's take a look at the shares of JetBlue and some of the other airlines, American and United. JetBlue up 8.3%. They pre-announced revenues to the upside. Very interesting, Matt. They are saying that because of the technology fiasco from CrowdStrike back in July, that customers on these other airlines that needed to rebook, well, they went to JetBlue. Therefore, they're able to boost the current quarter revenue view. But still, we see some of these other airlines, not Delta, that was the one that most affected, I believe, by that technology outage, up as well. Not as much, but overall the space is, to use the pun,
flying high. You can't count on any of them.
What's that?
You can't count on any of them, Abigail. Every time I'm on a flight, I think this is the worst airline that there is. Abigail Doolittle talking us through some of the stocks just about 45 minutes into the trade. Coming up, voters are getting a clearer picture, slightly clearer picture now of Kamala Harris's economic agenda, including a focus on small business and a lower capital gains tax rate than President Biden's proposal, but still a tax hike from where we are now. Details next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Tesla announcing plans to launch its full self-driving technology in China and Europe early next year. That announcement, of course, signals the company is on track to gain permission from authorities in those regions for the technology. Next up, Topgolf Callaway announcing a plan to spin off into 2 separate companies, Callaway Golf and Topgolf. Now, this move would unwind a 4-year tie-up between the golf club maker and the driving range operation. And finally, Verizon announcing it will buy telecom operator Frontier Communications for $9.6 billion. Verizon says that the takeover will make it more competitive in the U.S. Bloomberg Technology speaking to the Verizon CEO coming up in the next hour. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's take a look at what's going on in the markets right now. We've been kind of swinging back and forth a little bit today. Unchanged on the S&P has turned into a 0.5% gain now. 55.45, the level there, still 120 points away from an all-time high. The Nasdaq up almost 1% at more than 19,000, and the 10-year yield coming down, but about half a basis point right now at 375. After economic data at first disappointed and then came in line. Coming up, we're going to talk with e.l.f. Beauty about expanding its global reach with the CFO, Mandy Fields. Bloomberg Intelligence says the $110 billion U.S. beauty market is poised to grow thanks in large part to Gen Z's rising spending power. Abigail Doolittle has a closer look for us at one of the stocks in the spotlight today, e.l.f. Beauty. Abby?
Well, I can say personally, I love e.l.f. Beauty, especially a couple of the products in particular. And they have some good news out today, which is they're basically expanding internationally. Not a lot of reaction for the stock on this, down actually a little bit and over the last 2 days. You can see here a little bobble down. Let's take a look at the details of this expansion because they have announced their largest international expansion. They'll now be in 14 countries. Into this announcement, I do believe that about 16% of their net sales came from out of U.S. So that's really quite an opportunity if they do expand into other countries in the world to bring up that portion and perhaps boost revenues through those other retail channels. And if this is the case, we don't know that it is, but if this is the case, it could also help the stock get out of a little bit of a rut that it is in on the year. e.l.f., though, is not alone in this. e.l.f. Beauty down about 5.2% on the year. You can see Coty down a very healthy 25%. Estee Lauder down even more. So there's some issues. And then one interesting bright spot, I don't know that I would necessarily consider this to be a beauty company per se, but at least a personal products company of some sorts, up more than 20%. But again, an interesting expansion on the international side for e.l.f. Beauty announced today, Katie.
All right, Abigail Doolittle, really appreciate that setup. And let's keep the conversation going now with Mandy Fields. She is the CFO of e.l.f. Beauty. Great to have you with us, Mandy. And we'll get to the international expansion, but I want to talk a bit about why e.l.f. is the relative outperformer this year. You take a look at your most recent earnings report. Of course, you topped sales estimates, and e.l.f. is really known for offering value. I was actually speaking to our makeup room, and the artists there really like your $8 lip gloss, for example, as one of their favorite products. So when it comes to the market share that you're taking here, do you think that this is, of course, shoppers looking for value, or would you chalk this up to other factors such as Gen Z, marketing, et cetera?
Well, thank you so much for having me. It's great to be here again. e.l.f. is known for its value proposition, and I'd say it's really three things that we bring to the table. Value proposition being the top of that list. Our price points on average are $6.50. You just referenced our $8 lip oil, which people are going crazy for. And you couple that with our Holy Grail innovation and our marketing and digital engine, and you just have a recipe for success. And those are really the three things that have continued to propel our growth forward. In our last quarter, delivered 50% sales growth overall.
It's interesting. At the same time, you did see Wall Street really react quite strongly after what was positive earnings. And this was because of the point of sales acceleration. People are expecting even more growth, but at a time when the consumer is feeling some pain. How do you balance these expectations from the street and what you're seeing in the consumer landscape?
Yeah, so, what we have seen is that yes, consumers are being more choiceful. If you look at the category and if you look at where e.l.f. is performing, we continue to outperform the overall beauty category. And so that tells us that while the consumer is being choiceful, they're still choosing e.l.f. And so we're just going to remain focused on continuing to deliver our Holy Grail innovation, continuing to build our franchises out, making sure that that value stands front and center for what we're providing to our community. And they'll continue to be there for it.
A lot of growth has been bumpy out of the pandemic. People maybe didn't need stuff, then they did need stuff, and, demand really was volatile. You had analysts concerned that your point of sales growth, that your year over year comparative sales weren't quite strong enough. They want to see 20%. Are you going to get back to that? Are the comps bad for last year? I mean, what's your take on that?
Look, as they just mentioned, the consumer is being quite choiceful right now. And what we saw is a little bit of not as much of a buildup for back to school, as an example. And so what we're seeing out of the POS data, we continue to be very pleased with. And we also continue to be very pleased with what we're seeing digitally and internationally, as we just announced today. And so depending on where the mix of the business shakes out, that's neutral to us. We feel great about the overall health of our business and are not as focused on the week-to-week movements on the track channel data.
Fair point there. And before we go around the world, I do want to ask about Ulta, because of course we got Ulta results last week. They cut their sales outlook. The reason why was, we've heard this from so many reporters this earnings season, was this slowing consumer demand. I want to ask what that means for e.l.f. We know that your expansion within Ulta stores has been increasing. Do you have any concerns that Ulta is really struggling to draw those in-store shoppers?
Not at all. Ulta is a great partner to e.l.f., and we continue to see growth with that retailer, and they are a great partner to us. And so, like I said, as the consumer is being choosy on where they're shopping and what brands they want to participate in, e.l.f. continues to be a standout and continues to be a growth driver across our retailers and in the category.
All right, appreciate that context. So let's talk about that global expansion. Of course, you have a presence in 14 companies, or countries rather, and I was interested to see that actually your non-U.S. markets represent about 16% of your total net sales. As you look across the globe here, do you have a target for where you'd like to bump that share up to, or does 16% sound about right here?
Well, what I can tell you is that across our beauty peers, the majority of their business is actually conducted outside of the U.S. So with us at only 16%, and if you look at others in beauty with about 70% of their business outside of the U.S., the international expansion represents a really huge white space opportunity for us. And so, yes, we see nothing but opportunity ahead of us, 14 countries, but really only largely penetrated in 2 of those countries, being Canada and the UK, which continue to drive the majority of our sales. We're super excited about the launch in Rossmann and the early reads that we're getting there, but still a lot more ahead of us.
We're waiting for Donald Trump to speak at the Economic Club of New York later this afternoon. He has said he would put tariffs across the board at 60% on Chinese goods. You have about 80% of your supply chain in China and would face those tariffs, re-importing them to the U.S. Is that a concern for you? Would you move production around if that happens?
So we have a number of levers in our toolkit in regards to tariffs. In 2019, we were actually subject to tariffs at 25%. And at that time, we had to use a combination of things to help offset those tariffs. We had pricing taken on a subset of our goods to help offset, but we also had concessions from some of our suppliers. FX went into our favor. And now that we think about tariffs at a 60% level, we also have diversification at our hands. So if you would have asked me back in 2019 how much of our business or how much of our production was coming out of China, it would have been like 99%. We've diversified now down to 80%, and we continue to move that effort forward. And we love our suppliers and what they've done for us, but also want to have redundancies across the globe so that we can ensure that we're making the best of beauty accessible to every eye, lip, and face.
Mandy, I want to switch gears a little bit here and talk about consumer preferences here, because e.l.f. is a brand that offers clean, vegan products, was the first beauty company to achieve fair trade certifications, from what I understand. Now, I had family members in the makeup industry, and I wasn't allowed to wear makeup until I went to college, and a lot of that was because of the chemicals in the products and how close it was to your skin, right? So at the end of the day, how much do you see consumers really shifting gears here to those cleaner products? Is it a really large uptick by any means?
So consumers want, they want clean, they want vegan, they want cruelty-free, which is what e.l.f. stands for. To your point, we are also fair trade certified, which means that the suppliers that we work with are ethical. They've gone through a number of surveys, and all of the consumers looking for all of those things. If you think about Gen Z, they're very much concerned on environmental issues and all of those things. And so we want to make sure that we are giving our consumers what they want, especially as we expand internationally. There are different standards for clean and what that means across the globe. And we just want to make sure that e.l.f. is accessible and desirable wherever we go across the globe.
Mandy, we thank you so much for your time. That is e.l.f. Beauty CFO Mandy Fields. Now coming up, Jonathan Fascitelli, the former HBSE real estate CEO and now Seregh founder, joins us next to talk about the latest endeavor with a hot startup. This is Bloomberg. Since he left private credit giant Apollo Global Management, Josh Harris has been on a tear. He has built a new investment firm, 26 North, that inked its first private equity deal this week at a value of $1 billion. He expanded his own personal empire in professional sports, including leading a record-setting investment in the NFL's Washington Commanders. And his venture, alongside Blackstone executive David Blitzer, has been active in every major U.S. sports franchise and some international ones, too, with New Jersey's governor just this week pitching their firm to move one of their holdings, Philadelphia's NBA team, the 76ers, to New Jersey. Now, Harris Blitzer Sports and Entertainment sees this hunger for sports development projects as an opportunity. As such, they are now investing in sports and entertainment real estate global holdings. And the new firm's chief, Jonathan Fascitelli, joins us in an exclusive interview. And this is about the real estate around these large sports franchises. We were talking about New Jersey in the commercial break. What is the goal here? How big? Do you have a number on how large this opportunity is for you?
Look, the opportunity is huge. And when you think about a traditional arena, you think about parking spaces and vast open parking lots. But fans, when they go, millions of them want to go there early and grab a bite, want to stay afterwards for a nightcap. This foot traffic drives retail. And once you have retail there, people want to live there. It drives residential. And so there's a huge opportunity to develop around sports and entertainment venues.
It's a great point. You think about the Meadowlands, for example. Those parking lots, they are used for tailgating, which is very fun. But you're right in that people just filter out afterwards. But you do have the reality that those parking lots are already there. And a lot of these older stadiums, they're already established. So how do you plan to handle those types of situations where I assume you can't just rip up a parking lot?
No, that's a great question. So what we have is a lot of aging infrastructure. So if you think about the universe right now, there's 30 venues that are in planning and another 40 between 2030 and 2040. Those are venues that are either going to be redeveloped or relocated. Okay? Take that and then combine it with the decline in the downtown, the hits from COVID, the challenges of back to office. We need a catalyst. Once upon a time when you built a mall, you put a JCPenney or a Macy's in there, and that would be your anchor, and that would drive people in there. You put an AMC in. People aren't doing that anymore, but people are going to live entertainment. And so these live entertainment venues are incredible catalysts for urban revitalization. Yep. And they're really powerful for the community, they're really powerful for the teams, and they're a great opportunity for investors to invest and to develop a product that people want.
I mean, for whatever reason, I find myself at the Prudential Center a lot.
Oh, yeah?
Concerts.
Just hanging out?
No, concerts, right. Devils, whatever. And I wonder if you would, is it more expensive to rebuild an area like that than it would be to find, green space and put up a whole new project?
Look, the Prudential Center is a great example. There's a sea of parking lots around there. However, the city and the state is doing a phenomenal job. They're putting a new platform in at the station that will bring people to the center. And that's going to create a lot of opportunity to potentially develop some of those parking lots into
And there are a lot of restaurants and bars around the Prudential Center as well. So
there are some, but there certainly could be more.
Yeah.
The Prudential Center is a great place for people to come and then leave. However, once that area is developed, people will come and then they will stay. And that will create jobs, create additional economic output, and it will create new taxes that are very positive for the
I just
city
mean in
and the
terms
community.
of developing, like if I want to add an addition to my house, the architect will say, look, it's frankly more expensive to add the addition than it would be to knock the whole thing down and build it again. Is it the same in terms of your developments?
Yeah, look, it depends upon the venue,
Yeah.
and it depends upon where you are in the life cycle. The typical venue life cycle is somewhere between 25 and 35 years. At that point, you either have to spend almost as much to build a new one, or you have to build a new one. And then it just becomes a question of where, how, and what's best. But here, what we what we see is a real opportunity to develop around these venues.
Jonathan, just very recently, you had the NFL team owners vote to allow private equity investment into teams. A lot of this has to do with actually stadium redevelopment.
Yeah.
How much of an opportunity does that open up around the NFL? How many teams and stadiums do you see really diving into that?
Yeah, so two things. One, great question. So the private equity into the NFL, I think, is a blessing. I think the 10% cap suggests somewhere in the order of magnitude of $500 million of fresh capital. There are a lot of legacy issues, a lot of generational issues. So I think some of that goes to kind of the costs associated with transferring the asset from one generation to the next. I think there's some opportunity for distribution, and then a large share will go to the stadium redevelopment. That only leaves a little bit of capital left, and these projects around these venues can be anywhere from $1 to $3 billion. I mean, that's a lot of capital, and so private equity, I think, will spur the redevelopment of the venues, but I think there's a real opportunity to partner now with the teams to invest in the development around it, providing both the capability and the capital.
Speaking of development, very curious about your reaction to Phil Murphy's letter to Harris Blitzer Entertainment here, because you have been involved in this already to some degree, right?
Yeah.
And so can the 76ers move to Camden? What are the pros and cons here?
Yeah, well, I have to be measured in my words. What I would say is the following. One, the Sixers proposal that I was involved with and led for downtown Philadelphia is incredible. So taking a mall and then taking down a third of it, dropping an arena, think TD Garden, think MSG, and then enhancing an area around it that's that has shuttered retail, that has a large number of foreclosures, is a real opportunity to revitalize downtown, and it's a thoughtful proposal, and one that I know that Philadelphia is taking really seriously. As it relates to Jersey, the governor and his programs are incredible. We know firsthand from work that we've done in Newark, from work that we've done in Jersey City, the policies that came out of COVID to spark development and the acknowledgement and recognition that development can create real job opportunities, can create real economic output, can create real taxes, is foremost in the country and really commendable. And so the programs that they're offering and the thought process, it's something worth considering.
Do you need to sway residents of Philadelphia who are concerned about a new build adjacent to Chinatown and the effect it would have on the neighborhood there? Because I know there are some protests in Philadelphia. We have Philadelphian viewers writing in and asking about that.
Yeah, look, I think there's two sides to the story, and I think that there's a large majority that's in support of the Sixers staying in Philadelphia and that like the new location as well.
So at the end of the day, when you think about the opportunity that's largest from day one, this is a new company you're putting out there. So what are you going to be first spending money on? We understand that you're in the market for about $2 billion right now.
So right now we're reaching out to the teams. So the teams broadly recognize the opportunity to develop around their venues. They recognize it, one, as an additional revenue opportunity, and then two, they recognize it as a positive impact on the community and community development. So they recognize that they need to do this. However, they typically don't have the resources to do it. To build out a large-scale development company, if you're a one-team owner, does not make sense. It's a 5 to 7 to 10 year project. You're not going to staff a whole company to do it, and that's where we come in. We come in as a partner to teams, and we'll work with them not only to support their redevelopment or relocation decisions for their stadium, but we'll come in and we'll master plan the broader development and we'll finance it with the capital that we provide.
All right, Jonathan, really enjoyed this conversation. Great to have you on set with us. That, of course, is Seregh founder and former HBSE real estate CEO, Jonathan Fascitelli. Meanwhile, happening right now in New York at our world headquarters, we have Bloomberg Power Players, where we've gathered industry leaders, investors, and athletes who are revolutionizing the business of sports. That's Bloomberg's Jason Kelly speaking with Atlanta Hawks co-owner Grant Hill. And later today, NBA's Steph Curry will be speaking about winning the brand game. You can, of course, tune in to the panels on Live Go on the Bloomberg terminal or stream it on Bloomberg.com. Meanwhile, the Kansas City Chiefs have been on a hot streak, and I'm not just talking about the Super Bowl. Clark and Dan Hunt are spearheading the league's hopes of expanding their global audience. Here's what they had to say about how Taylor Swift helped grow their fan base.
It was really an amazing year, and not only because we won the Super Bowl for the second time in 2 years, we had tremendous growth in our fan base, and there's no doubt that a lot of that related to Travis's and Taylor's relationship. It was something that frankly caught us all by surprise, and almost every week I had somebody come up to me and tell me that my daughter, who's 10 or 11 years old, she wants me to tell her anytime the Kansas City Chiefs are playing on TV. And they would say she's never been an NFL fan, but she is now a fan of the Kansas City Chiefs. So it was a real blessing in that regard. The most important thing there is Travis's and Taylor's relationship. I'm so happy for both of them.
But good for business, right?
Absolutely. In terms of growing our brand, we had a 30% growth in our fan base, which is a huge number, even in a year when you win the Super Bowl. And certainly I think the NFL enjoyed an uptick from a media standpoint across all of its platforms.
And if you're an NFL team, I hear J.Lo is single. That, of course, was Clark and Dan Hunt. They are owners of the Kansas City Chiefs.
Wait, isn't she not with Ben Affleck? Is that not?
Yeah, they filed for a divorce. Are you not up on this?
No.
Okay.
But they were together and then apart and then together?
Bombing his Instagrams with lots of J.Lo information.
Yeah, there you go.
DMs.
Yeah, we've got to get you up to speed on this show. But in any case, I swear that was relevant because you can read more of that conversation on your Bloomberg terminal if you type in NI Big Take. But we should get back to markets here. Of course, we know it has been a brutal start to September, and we actually were looking at gains earlier in the day on the S&P 500. Now, not so much. Small moves overall, but still, the direction of travel has been cleared. We are now lower by 0.1% on the big benchmark. You flip up and you take a look at the NASDAQ 100. Your big tech stocks doing a little bit better, but still down from session highs. The NASDAQ 100 currently up about 0.2%. And the bond market, we had been looking at gains. Of course, yields were lower on the day. Now we're back to unchanged. We did get a lot of economic data today, guys. You think about, of course, we got ADP, we got initial jobless claims, then we got ISM services at the top of the 10 o'clock hour. You add it all together and it adds up to unchanged on the 10-year Treasury yield.
The 2 years, 2 basis points higher, which is incredible. We're at 377 now.
It's amazing, Sonali.
Leave me alone, Matt. Leave me alone. I'm just saying, this morning we were barreling towards 370, and we have not only given up all of those gains in the bond market, we've actually lost some ground. Fascinating.
I mean, I think the interesting thing is where the market is pricing a rate cut, or what probability the market is assigning to 25 basis points versus 50 basis points, because we've seen that move around,
but within a margin of error, because it's really been 50-50 or give or take around there for a while now. And of course, it feels like, what did you call yesterday, or the jobs report, the Big Daddy?
Well, it's actually referred to normally as the granddaddy of all economic statistics.
Can we start calling it
the non-farm payrolls? And by the way, I want to tell
gendered thing to do.
Okay, a grand mommy, a grand person. It's the grand they of all economic statistics. I think I just want to remind viewers, especially if you have a Bloomberg terminal, well, only if you have a Bloomberg terminal, if you type in WHIS-GO, you can enter your own forecast for the non-farm payrolls number. And a lot of people have been doing it. It's really a big deal. Getting on that winning roster, I think, is a really big deal in finance.
Oh, I mean, it's like quiz go.
Better than winning the quiz.
I don't know. Winning the quiz.
What
feels,
are we betting tomorrow
sweet.
Morning, guys?
165. You know, I would say it comes in a little stronger. I think I'm gonna go contrarian and say it's gonna be a little heavier than 165.
Fascinating. Even after the data you saw this morning on ADP.
And the whisper number is lower. The whisper number is at 155.
But you know what?
But I'm hopeful. You know, I'm an optimist.
What I wonder, and I'm obviously always looking for problems, but you know, when you think about WIRP and the expectations, you have to wonder if you have that supersized cut back on the table by tomorrow.
All right. Well, all eyes on 8:30 a.m. tomorrow, but that does it for us for now. This was Bloomberg Open Interest, and this is Bloomberg.